Okay, so we are all welcome back to today's lecture. Today we shall continue from where we stopped. The last time we were able to look at the modified internal rate of returns. We also look at the free cash flows to both the company, that is, to both the equity and debt holder. We also look at the free cash flow to only the equity holder. So today we are going to continue from there. We shall be looking at continuation from that angle. Okay, free cash flow. And so we are not going back to modified internal rate of returns. We've done that. And whenever we're looking at free cash flows, okay, we are looking from the, okay, yeah, they talk about the net present value versus the internal rate of returns compared. We have looked at all those things. Then where are we actually? We are, yeah, modified internal rate of returns. We also look at this. Then we are looking at free cash flows now, which we are going to go straight to. So this is where we are starting from: free cash flows and surplus projected cash flows. Now, when we are talking about free cash flows, though we've looked at it in details, but for the fact that you are just joining the call, I felt I should just quickly touch on it before we move away from there. So free cash flows can be in two ways. It can be free cash flows to the whole company, right? It can be free cash flows to the whole company. It can also be free cash flows to only the equity holders. So we have who we call the equity holders. We also have the whole company. So when we talk about the whole company, we're talking about both the equity holders. We're also talking about the people that borrow us money, the debt holders. So free cash flows can be used to calculate the value of a company. We hear business valuation, you hear mergers and acquisition. So if you don't have the knowledge of free cash flows, you will not know what to do when you get to those other big topics, because here we are treating it in details. Then when we get to our business valuation, we get to mergers and acquisition, we not go into details into the free cash flow any longer, because we believe majority of the people must have had this foundation and they are only building on the knowledge that they've gained from this class. Okay, now, as I said before, free cash flows can be to the equity holders. It can also be to the total company. So when it's to the total company, it means that both the equity holders and the debt holders, they all have access to it. So also, how do we get our free cash flows? So to get your free cash flows, you are talking about what is that money that is available after you've settled all your debt, you settled all your everything that needs to be settled. You've paid everybody, you've paid tax, you've paid interest, okay, you've adjusted for non-cash items. When we talk about non-cash items, we're talking about things like depreciation, things that does not involve the movement of money. So when you have settled all those things, whatever is remaining, they call it free cash flows. So that free cash flows, you can either decide to use it to pay dividend. You can also decide to pay interest out of it, pay dividend and all that. So it depends on who owns the free cash flows. If it's the equity holders alone that own the free cash flows, then we might need to deduct our interest first, because the money that is going to remain is not for the interest holders. So it's only for the equity holders. So when in that case, whenever the free cash flows that is left, we want it to only be to the equity holders. What we normally do is that we deduct our interest first before we now do our other calculation. So it means you go and take your profit before interest and tax, deduct your interest. Then after you deduct your interest, deduct your tax. Then you now adjust for non-cash items. Non-cash items like depreciation. Then when you have adjusted for so depreciation, now you are going to add it back, because normally accounting terms, accounting law says depreciation should be deducted. So before you got your profit before interest and tax, you must have deducted depreciation. Now, do not look at that depreciation. That depreciation is not a cash item, does not involve the movement of money. So what will they do? They will add it back to the profit before interest and tax. So once they add it back to the profit before interest and tax, okay, after you've done that, then you also ask yourself, is there any capital project I want to do, okay, so that I don't spend that money, because we are looking at free cash flows that we can spend as we like. So we need to make provisions for all those things that we know that we actually need to buy. For instance, you have a fixed asset you want to buy, you have a plant that you are going to use for your company, you have a land you want to buy, you have this, so any capital project, also deduct it from that your money. Then you also check out for your working capital. So your working capital can be in two ways. Either your working capital, there's an increase in working capital, or there is a decrease in working capital. So when there's an increase in working capital, it means they need more money for working capital. So what do? You also set it aside. If they need more money for working capital, you needed to also set it aside, so that when the time comes to use that money for that project, they will not be looking for it everywhere. So you needed to set that money aside also for your working capital. Then the next thing is that is, if there is an increase in working capital, you deduct it. But if there's a decrease in working capital, then you add it. What does it mean? It means that we've already predicted that we needed 5 million as working capital. But lo and behold, we now discover that in reality, we don't actually need that money. We don't need up to 5 million to execute that project. Initially, we thought we needed 5 million. We've set aside 5 million for the project. But later, we now discover that the 5 million we are setting aside is too much. So if there is a decrease in working capital, you add it back, because it's money that you set aside before for working capital. But you now discover that you don't need that much for working capital. So what will you do? You have to add back that excess to it. So that is why we now have this template. So this template now, what you need to do, just check. After you have your profit before interest and tax, did they deduct interest? No. If you are going to deduct interest, they will always deduct interest before they deduct tax. So here, they just went straight to deduct tax. So anytime they deduct tax and they don't deduct interest, just know that the free cash flows they want to get belongs to the total company. It means the interest that we're going to pay to debt holders, we know that we can still pay them from the free cash flow at the end. So therefore, we don't need to deduct it here, because the free cash flow does not belong to only the equity holders alone. It belongs to the total company. So that is why you take, after your profit before interest and tax, what are you deducting first? If you are deducting interest first, it means you have settled the interest holders. No need to come and settle them again from the free cash flows. But in the case whereby you didn't deduct interest, it means the money you're going to have there belongs to both the equity holders and the debt holders. So the format is almost the same for when you are preparing this free cash flow for the total company, and when you are preparing the free cash flow to the equity holders alone. So let's check it well. We have our profit before interest and tax. We less our taxation. Okay, we are less our taxation. So it means, how do we get that? We say our profit before interest and tax multiplied by the tax rate. We are going to get the tax to less. Then the next thing is that we now add back non-cash items such as depreciation, because they don't involve movement of money. So they don't involve movement of money. We are adding them back. Then the next one, is there any capital project you intend to undergo so that or undertake, so that the money that you have, you don't spend everything, whereas there's a project you needed to do. So any project that you need to do, you also set aside that money, less that money away from it, so that you don't spend it, you don't squander it. Then the next thing is that you less or you add increase or decrease in net working capital. So increase or decrease in net working capital, you needed to either add it or you less it, okay, depending on what you are having in your question. So after you've done all those things, you're going to get what we call the free cash flow. So there's this illustration we looked at yesterday that assisted us to understand all this. So there's a format already. All you just needed to do is just take that format, slot the figures inside. So let's get it. They say HWT PLC has earnings before interest and tax of this value, 225,000. For the current year, depreciation charges for the year have been 15,000, and working capital has increased by $2,500. Then I say that the company needs to invest 22,500 to acquire non-current assets. Okay, so they need to invest 22,500 to acquire non-current assets. Remember, I told us about if there's any asset you want to buy, you needed to set aside that money. So this is it. Then we've looked at depreciation charge for the period is like 15,000, which this 15,000 is not a cash item. It's a non-cash item. Then they also talked about working capital. They say there is an increase in working capital. So if there's an increase in working capital, it means that they need more money for working capital. So what do? You set it aside in case they come for it. That where is the money? So you don't start telling them stories. So set aside the money they need for working capital. Are we together? Are we together?
Yes, sir.
All right. That's cool. That's fine. So now the next thing we want to do is this. We want to now go a step further. Yeah. Okay. So another thing we want to do is we want to now check this question. Insert those figures into this template and see what we have. So the first thing is where is our earnings before interest and tax? It's obvious. This is 225,000. We pick it. The next thing we now say, we need to less taxation. Where is our taxation? So our taxation is always going to be prepared. It's going to be 20%. Sorry, what's our taxation rate? Our taxation rate is actually 30%. So it's going to be 30% of our earnings before interest and tax. So if you take 30% of 225,000, you are going to get this value, which is 67,500, which is our taxation. Then the next thing, you do some adjustment. The first adjustment you're going to do is you add back non-cash items. What are the non-cash items? The non-cash items are, number one, depreciation. Depreciation does not involve movement of money, okay? It does not involve movement of money. So what you do, you need to add it back. Then the next thing, is there any capital project you intend to embark upon? Is there an asset you want to buy? So whatever capital expenditure you want to incur, also set aside the money so that you don't squander it. Once you set aside that money, then the next thing is that you now also check, is my working capital increasing? Is my working capital decreasing? So you check for increase or decrease in working capital. So if working capital is increasing, you needed to set it aside because they will come and ask for that money because working capital is increasing. They need more money as working capital. So you come and set aside that money, increase in working capital. But if working capital is reducing, then you need to add, okay? Then the last thing we are talking about is after you've now done all those plus and minus, you're going to get your free cash flow. Now, the question to ask yourself is, this free cash flow that we got, does it belong to the total company or does it only belong to the equity holders? Now, if you check, whenever you check, you see that they charge interest. If they charge interest in the question, that they deducted the interest already, you can see here that it's only tax that we deducted. We didn't deduct interest. So because we did not deduct the interest, it means the interest people, their interest is in this place. That means that they also have a share of this free cash flow. So this free cash flow that we got is for the whole company. Is for the whole company. So we now move further and say, okay, what if we want to only prepare free cash flow that belongs to only the equity holders? What if we want to only prepare a cash flow that belongs to only the equity holders. Let's settle the debt people, the people that have the debt holders, and only pay and only leave the cash flow that belongs to the equity holders. How do we go about it? Okay, so that's a question actually that we're asking right now. How do we go about it? So now, this is what we do. The same thing you've done before is what we are going to do. However, there is a little adjustment that needs to be done. A little adjustment needs to be done. And what is that thing that needs to be done? This is it. We now check. We are starting from our profit before interest and tax also. But because this time around, we want whatever is remaining, we want it to only belong to the equity holders. So what do? We settle the debt holders. We settle them. We less the interest that belongs to them. Okay. When we less the interest that belongs to them, before we now come and less taxation. Then the next step is we now add back our non-cash items, which is depreciation. Then the next thing we want to do is that we less our capital expenditure as we did before. We less our increase or decrease. We less increase. We add decrease in net working capital. Then the next thing we want to do. So this is where the difference now coming. So number one, know that you are not giving this free cash flow that is remaining does not belong to the debt holder. So you need to settle them ahead. Settle them first. You first of all give them their interest that belongs to them. Then also less your taxation, which is normal. Then add your non-cash items such as your depreciation. Add your non-cash item such as your depreciation. Then once you have done that, then the next thing you want to do is you want to now check for you less your capital expenditure, you less your increase in working capital, or you add your decrease in working capital. Then the last difference now is these two things. You now ask yourself, how much did we actually so the debt we issue now, because when we are trying to gather those loans, okay, there's a debt instrument that we issued. So how much did we raise on that debt instrument that we issued? How much did we raise? Now you can raise like 20 million, but you've only repaid only like 10,000. So you want to add all the cash that you raised from the debt issued. So you want to add all the cash that you raised from the debt issued. Then you now less the debt repayment that you've made. Maybe you issued a debt, okay, the debt instrument, and you made like 20 million, right? However, it's not all those money that will become due at the same time. Probably some you will settle them before the expiration of that stuff, and some you might need to. So you can see that here we add all the cash that we raise from the debt instrument that we issue. Then we now less the debt that we have repaid. Remember, it's because we raise debt instrument. That is why we are paying them interest in the first place. Because we borrowed money from them, that is why we are paying interest in the first place. So what you now need to do is that you add your cash raised from the debt issued, and you now less debt repayment, okay? You let the debt repayment. So what else do we need to do? Once you have done that, okay, then the next thing you want to do is you now do your plus and minus. You're going to have the cash, the free cash flow that belongs to only the equity holders alone. Why? Because you have settled the debt holders. You have settled the debt holders. You have repaid their loan. Here you less debt repayment. You settle their loan. You also pay them the interest that belongs to them. Then you now come here. You now had the money that you raised from the debt instrument. Are we together? Are we together? Is anybody on the call listening?
Yes, sir. Yes, sir.
Yes. All right. So thank you. Now, then we now go further. Another thing you want to now do is that there's this thing they call dividend cover. This dividend cover will make you know how many times will the money you have, like the net profit that you have, how many times can you pay? You know, after you've paid everybody, you've paid everybody. Okay, you settle the debt holders. You said you're not asking yourself that, okay, this free cash flow that is available, how many times will it take us to actually settle the dividends that we want to pay to the dividend holders? How many times will it take us to settle them? So you want to ask that kind of question so that you can know what you are doing. Okay, so that is that. You want to do that, and that is actually fine. So to get your dividend cover, you go and calculate your free cash flows to equity alone. Then you now ask, how much dividend is payable? So the dividend that is payable is what you now use to divide what you have already gotten. Are we together?
Yes, sir.
All right. So with that being said, let's now move further. So when we check our dividend cover, we are saying the free cash flows to equity that we've calculated. Note that we have settled. Whenever you're even talking about dividend, know that dividend belongs to only the equity holder. So we now say, okay, the free cash flows that we got for equity holders alone, we divide it by the dividend that is paid. So yesterday I gave them a class work. I don't know if it's this one, but let's quickly go through this question and see what we can make out of it. So they say the following data relates to MLX Limited. We have forecasted income statement for the year. We have revenue. We have cost of sales, right? We have profits, gross profit. We have opening profit. We have earnings before interest and tax. Now remember, you're going to go and pick your earnings before interest and tax. The format we have to start from earnings before interest and tax. Then you now ask yourself, are we paying? Does the free cash flows you want to get, does it belong to only the equity holders, or does it belong to the debt holders? Once you are able to determine that, it will tell you whether you needed to settle to pay interest, or you don't need to pay interest at all. So now, once we have said that, okay, once that is said, then we now say, okay, let's move ahead. So the next thing we're going to do is, once you pick your earnings before interest and tax, then determine, are you doing free cash flows to the company, or are you doing free cash flows to only the equity holder? So let's now check this. It said during the year, loan repayments are expected to amount to 60 million. Depreciation charges to 30 million, and capital expenditure to 60 million. So they now say that the dividend payable is 30 million. So with this information now, when they've already given you the dividend payable, that means that you may be asked to prepare the dividend cover. So it means that you might need to get the free cash flows to equity holders, so that you're not divided by the dividend that needs to be paid. Okay. So they say required, calculate, number one, free cash flows. So when they say free cash flows and they did not specify whether to equity, they are saying free cash flows to the total company. Are we together? Yeah, I believe we are together.
Yeah.
Okay. So now let's now move further. Let's move further. Okay, so let's move further. Let's move ahead. So the next thing we want to look at is this. They now say, okay, after you have done that, then you now do the free cash flows to equity, and then do the dividend cover based on the free cash flows to equity holders. So now suggested solution is here. So let's now look at it together. So I told us, always start with your earnings before interest and tax. So we pick it from the question. This is the amount of the question. We came to pick this guy. We picked this guy here. So let me color it so that you understand that that is what we picked. So once you pick this amount, then you now come over here. That's what we have over here. Then we now do what? We now less taxation. Now, once you less taxation, obviously, you know that whatever you're going to get at the end, somebody should give me expo. If you less taxation first, what kind of free cash flow are you going to get? Who can tell me? If you less taxation first, what kind of free cash flows are you going to get? Hello? Can you hear me? I've given us Expo now. I've said it over and over and over. I expected that by now we should know what is up for grab. Okay, so whenever you, let me check if there are people on this call.
Free cash flows to the entity.
Okay, free cash flow to the entity. Why? Why are we going to have free cash flow to the entity? Okay, yeah. So you are correct, actually. So free cash flow to the entity. So probably you should have mentioned, when you say entity, something like equity. Okay, so this is free cash flow to the company. Now, anytime you are deducting your taxation first, whatever free cash flow you are going to get is going to be the free cash flow to the total company. But when you deduct your interest first, you're going to get free cash flows to, so when you deduct your interest first, you're going to get free cash flows to only the equity holders, because you are settling the debt holders. You are saying, okay, pay them and let them go. You are settling them first, then what we remain will not be to the equity holders alone. But now, we are not settling the debt holders. That means that their interest, you are going to pay them from the free cash flow that is remaining. So what do? We now say, okay, the earnings before interest and tax that we have, we now less taxation. After less taxation, then we now ask ourselves, what are the things that we need to do after taxation? We need to add back the non-cash item, number one, which is depreciation. You check the question whether there's depreciation. Number two, we need to less any capital intensive expenditure that we intend to incur. We need to also check for working capital. Is our working capital increasing? Is our working capital decreasing? Okay. Once you've done those two adjustments, before you can now have your free cash flow. So we now go and check. The first thing you want to do after tax is to add back non-cash items. So do we have depreciation in the question? You go and check. From here, we don't have depreciation here, but here, they say during the year, loan repayments are expected to amount to 60 million. Depreciation charge is 30 million, and the capital expenditure is to 60 million. So depreciation is there. So we're adding back 30 million. Everything is in million. So we now add back our 30 million to this place. Then we now less, because we need to check for capital expenditure, we need to less it. We need to also check for increase or decrease in working capital. We also check for it whether it's going to be there. So with that being said, I think we can now go further to continue solving. Okay, let's go further to continue to solve. Okay, hold on. I'm coming. Hold on, no. I'm coming. Okay, so that is that. That is that. So we now come over here and we now say that, okay, that being said, we now have this value. So there is a capital expenditure, which will less, but there is no working capital. They didn't tell us about any working capital. So that is why we just have it at here. We stop here. Then we now have our free cash flow to the, sorry, this is where we are. That's how we stop there. Then we have our free cash flow to the entity, okay? Because you have not settled the debt holder, so everybody owns it. The total company owns it. Then that is one way. Then after that, we should also calculate for free cash flows to equity. Now it means only the equity holders are going to get the free cash flow. It means that you must settle everything that relates to debt. So what do? You can also go and pick your earnings before interest and tax. Then what do? You settle your interest because you want to pay them off. When you settle your interest, then, okay, somebody's hand is up. Yes, what's the issue? Okay, yeah. Did somebody send a message? Let me see. Okay. All right, no issue. You get it. So when you now come over here, you are trying to do free cash flows to equity alone. So what do? You now say, okay, start with your earnings before interest and tax. You pick it. When you pick your earnings before interest and tax, the next thing is that you now less your interest, which is you are settling the debt holders first. Then after that, you also less your tax. So what you'll be having is going to be profit after tax. So instead of you picking profit before interest and tax, when you are trying to calculate, whenever you are trying to calculate, what's it called now? You're trying to calculate free cash flows to the equity holders alone. You can always go and pick, because you are settling the debt people off, you can go and pick profit after tax and you are safe. Okay, just pick your profit after tax and then you are safe. Then the next thing you now do is that you need to now, after tax, whenever we treat tax, the next thing we normally do is that we now ask ourselves, is there any non-cash item that we needed to add back? So this is just almost like when you're doing your cash flow statement. Under the cash flow statement, you pick your profit, now add back non-cash items. So I don't know if you can still remember the format of your cash flow statement. So we now come here, we add back the non-cash item, which is in this case is actually depreciation. So when we add back the non-cash item, then the next thing we want to do is we want to now less the capital expenditures, right? Less the capital expenditure. You also ask yourself, do we have working capital? Is it increasing? Is it decreasing? So you treat that as well. Then there are two things that you also need to take note of. Apart from the interest that you're going to less, because we are doing free cash flow to only equity holders alone, apart from the interest you're going to less, you're going to also do two things. Number one, you will add all the cash that you raised on that debt instrument. Okay, all the cash that you were able to raise from the debt instrument, you add it. Then the people that you have paid back their loan, you also less that loan that you have paid them, so that you know what is remaining. So you will not say, okay, this is the profit after tax, this is it. We now add our non-cash items such as depreciation, we less working capital, we less capital expenditure, we treat our working capital, either it is increase or decrease, we also treat that. Then the next thing we want to do is we want to now check out how much did we actually raise from the debt instrument that we issue. So you say how much did we raise, you're going to add it. Then how much have we paid back to those people that we are owing, you less it. At the end of the day, you do your plus and minus and you're going to have the free cash flows to add to the entity. Okay, so that is that. So for your dividend cover, what do? You now take the free cash flow to equity that you have gotten, which is this value, okay? You now divide it by the dividend paid. Once you have done that, you are good to go. Okay, so that's how we did this. And we now decided that, okay, if we have a free cash flow to the equity to be 89.18, then we have a dividend to be 30, then how many times can we settle this dividend out of this money? You can settle it twice, because from here, we can see 30, we can see 230, like if you want to get 30 in this place, you can get 30 million twice, okay? So that's why they say 2.97 times. So the next thing we are going to look at is now valuing a firm using the free cash flow. So before we do that, I needed to check whether we are recording. Okay, we are recording the class. So quickly, just give me 2 minutes and I will be right back to explain this to you. Just give me 2 minutes, okay? So why I'm away, try and read it and digest what is here. Okay, so all right, I'm back. So let's check. Yeah, so I'm back now. Okay, so let's move on. Now, valuing a firm using the free cash flow. I told us the other day that when you start looking at free cash flows, then you can start talking about how to value a business. You talk about business valuation, we talk about mergers and acquisition. All these are things you must know so that when you get to that those kind of topic, it does not look so confusing to you. Now you discover that everything we are going to do here is just a build up for other topics that we're going to treat in the future. So don't take any of them for granted. Anything we are learning, don't take it for granted. You are going to see where it's going to be useful to us. Even the net present value that we did before is going to be useful to us. Even the IRR, internal rate of returns that we did, you're going to need this in bond valuation. When you're doing bond valuation, you will need the knowledge of internal rate of returns. So everything is interwoven, even in your cost of capital, okay? When you're trying to do cost of debts, when you're trying to do cost of redeemable debts, you also need the knowledge of IRR. So there's nothing that is not interwoven or interrelated and all those stuff in SFM, okay? So every topic is very important. Now, let's now look at it. They say, valuing a firm using the free cash flow. This method values a firm as the present value of future cash flows. So it values a firm as the present value of future cash flows, discounted at the weighted average cost of capital. So discounted at the weighted average. So that is not here. They say the discount rate applicable should be the rate that reflects the risk, the level of risk attached to the cash flow. So now let me explain something. When we are calculating our free cash flows, you can either decide to calculate free cash flows to the whole company or calculate free cash flows to the debt holders alone, right? Based on what we have said. Now, if you are doing that, then the thing is, you now make sure that if you do free cash flows to debt holders to the total company, then you know that okay, the free cash flow that are going to have, both the equity holders and the debt holders are going to benefit from it. So use weighted average cost of capital for it. However, if you do the free cash flows that belongs to only the equity holders, then you have to discount it using the cost of equity. Are we together?
Yes, sir.
Okay, so let's now quickly look at this. They say this method values a business as the present value of future cash flows, right? They went for that to say the discount rate applicable should be the rate that reflects the level of risk attached to a cash flow. They went for that to say that corporate value is calculated as the present value of free cash flows using the weighted average cost of capital, WACC, as the discount factor. So now to get our corporate value, we say our value of equity plus the value of debt. That gives us our corporate value. So that's how to get our corporate value, our value of equity plus value of debt, obviously, because when we are trying to get our corporate value, we are trying to get the value of the total company. And that time we don't deduct our what's it called, our interest. We also don't repay the loan that we are owing these people. We don't show loan repayment, right? We also don't add the proceed that were made from the sales of that stuff. We also don't show it. So at the end of the day, you discover that we only have the value of equity. But if so when you don't deduct the interest and everything, you have the corporate value, I mean to say, which is the value of the equity plus the value of the debt. Okay, so give me 2 minutes. I need to connect this this thing is getting hot and I don't want it to crash. Okay, so that being said, yeah, so with that being said, then we need to continue. Now, the next thing we want to do is that we already know that the value of the corporate value is the value of equity plus the value of debt. Therefore, to not get the value of equity alone, we say the value of the corporate value, we now minus the value of debt from it. It will give us the value of equity alone. Okay, so that's how we always do it, to give us the value of equity alone. So let's now try and also now solve some questions in this regard to see what needs to be done. So we now come over here, we now say we already understand all this. We now say that alternatively, value of equity can be calculated as the present value of free cash flows to equity using the cost of equity. So if you want to get your free cash flows to equity, or you want to get the value of equity, we can either have the value of the company, the corporate value, or we can have the value of equity alone. To get the value of equity, we are going to take the free cash flows to equity. We now discount it using the cost of equity as discount factor. So I hope you can hear me clearly. Okay, I hope you can hear me clearly. Now, let's now move further. So this is the value of company. We say corporate value equals to present value of future cash flows, okay, discounted at the WACC. Then corporate value is always equal to the debt value plus the equity value. Then I say that equity value equal to the corporate value minus the debt value. Or we can also say free cash flows to equity divided by equity value, okay, equal to present value of free cash flows to equity discounted at the what? The cost of equity. So let's get a question. Somebody should read for me and read all this. So in this question, you're going to see where, anytime you have cash flows, okay, and those cash flows, they are in the future. Know that one thing is calling you, you must do discounting. You must discount them to present value. And when you are discounting, also check the cash flows. Are they identical? If they're identical, then you will know whether to use the normal discounting factor, which is for each period discounting factor, or to use annuity. If those things are unique, they are the same, you can decide to use annuity. Okay, you need to learn all those things. You need to know when to use annuity, when to use normal discounting factor, and all that. So somebody should read this question for us quickly. Somebody should read for us quickly. Remember, we have 1 hour to the end of this class. Who is reading for us?
Tauto Limited. The finance team of Tauto Limited has produced the following forecast of financial data. We have the financial year, that's year 1 to 4. We have the net sales for each year, cost of goods sold at 50%, selling and distribution expenses, capital allowance, interest, cash flow needed for asset replacement. Corporation tax is at the rate of 30% per year, payable in the year that the taxation cash flow occurs. Assume that the company's weighted average cost of capital is 14%. The market value of debt is $30 million. Required: calculate the value of the company if cash flow are expected to remain at fourth level into infinity. Cash flows are expected to remain at fourth level up to the end.
Year four
Year
level.
Okay. Year 4 level up to the end of 14 years horizon, cash flows are
Right.
expected to grow at a rate of 3% per year after 4 years with a direct cash flows are expected to grow at a rate of 3% per year after fourth year into infinity. Cash flows are expected to grow at a rate of 5% per year after fourth year to sixth year inclusive, and then at 4% indefinitely.
Okay, so yeah, so this is a question now. So with this question, with the knowledge that we've already had, let's therefore try and make sense out of it. So what are the things that we needed to note? The first thing is that this question, they are giving us cash flows, and we already know that these cash flows, we needed to discount them to the present value. So one thing we needed to figure out is we need to calculate the free cash flows. What they give us is like a financial statement. They give us the net sales, they give us the cost of sales, they give us the selling and distribution, whatever. We need to calculate our normal account stuff. They also give us the capital allowance, which is going to act as our depreciation. They went further to give us the interest that needed to be paid. At the end of the day, they gave us the cash flow needed for asset replacement. Cash flow that is needed for assets. So you know that when you want to replace your assets, you need to buy assets. Okay, so those capital intensive purchase. So those are the figures. Then next thing, they now give us the corporate tax to be 30% per year, payable in the year that the taxable cash flows occur. Then I say, assume that the company's weighted average cost of capital is this amount, then the market value of debt is this amount. So they are expecting you to be able to get the value of the company. And once you get the value of the company, you also be able to get the value of equity. So let's look at what we have over here so that you can understand what we have. So to solve it, whenever you're solving any question, always say Auto Limited. The name of the company, put it, suggest a solution, Auto Limited. Okay. You have the years, you have this like this, then you now go and take those things, the sales. This is the sales, right? Then you know cost of sales. Cost of sales will always be deducted. It's going to be jacket. We jacket our cost of sales. The next thing we're going to do, after we jacket our cost of sales, normally we should get our gross profit, okay? You can also go further to go and take away your selling and distribution expense, so which also was jacketed, right? We also jacket it. Then we also have what we call this capital allowance. Now, capital allowance is actually in accounting terms, capital allowance is like your normal depreciation, right? So capital allowance is to get your profit before interest and tax. We normally deduct capital allowance, right? So now if they deducted capital allowance, then to now work back after you get your profit before interest and tax, you need to add it back. So that's what they did. So they deducted the capital allowance as though it's a depreciation that they deducted to get the profit before interest and tax, which is the normal accounting treatment for depreciation or capital allowance. After they've done that, okay, then we now say, okay, what are we doing? Are we trying to get what's it called? Are we trying to get free cash flows to the equity? So to equity, or are we trying to get free cash flows for the total company at a go? So we now determine that, okay, we are trying to get free cash flow to the total company, right? So what do we now do? We now say, okay, because of that, we will not subtract our interest. Though they gave us interest rate in the question. This is the interest rate, 18, 16, and so on and so forth. So we will not deduct interest rate because the free cash flow we are trying to get is for the total company. So we are not deducting interest rate first. What do we now do? Before we deducted our tax, we deducted our tax. You can see tax is at 30% of whatever your profit before interest and taxes. You take your 30% and you got this. Then the next thing, you need to add back the non-cash item, which in this case is actually capital allowance. The non-cash item is capital allowance. You have to add it back. Then the next thing we want to do is that we now want to ask yourself, is there any capital expenditure? Is there any working capital that we also need to check whether it increased or it decreased? So those are the two things we need to check, because we are dealing with free cash flows to the total entity. So we now come to the top, we check from our question, do we have assets that we want to buy? They say cash flow needed for asset replacement. You can see cash flows needed for asset replacement are this amount. So in order for us not to spend that money, because we are looking for free cash flows to the company, okay? In order for us not to spend the money, what do? We need to deduct that money that we want to use to buy assets. So we call it capital expenditure. We don't want to deduct it. We also ask ourselves again, do we have any working capital that we need to also check whether it's going to increase or it's going to decrease? In the question, they didn't give us any information about working capital. So in the additional information, they say the corporate tax rate is 30% per annum. The payable in the year that the taxable cash flows occur. They also said that assume that the company's weighted average cost of capital is 14%. The market value of debt is 30 million. So no information was given about working capital. So because no information was given about working capital, we simply left it, right? So how do you know what they are asking you to do? Check. They say calculate the value of the company. So this is the only method we've taught you how to calculate value of company. Okay, using free cash flows method. There are other methods, okay, when you're doing business valuation, okay, but this is a method. When you're doing your mergers and acquisition and all those stuff, you might need to value the business before you start deciding whether you want to buy or you cannot buy, or whether it's profitable or it's not profitable to you. So when I come over here, we now say, here, we've considered the capital expenditure, right? Then there is no working capital to consider, no. So after that, we do our plus and minus, right? From here, we'll be able to get our profit before interest and tax. So let me underline it where the separations took place. We've done profit before interest and tax using our normal accounting understanding. Now, we've done that using our normal accounting understanding. Then after we've done that, we now went further to now say, okay, let's now do the free cash flow itself. From here like this now is our normal accounting understanding that we use from year to year. Normal accounting understanding. Then afterwards, that is where we now come and use the knowledge of our free cash flows. We only deal with the movement of cash. We only deal with the movement of cash, okay? So that's where we came to do that in this place. Are we together? Are we together? Yeah, so we treated normal accounting stuff here. Then when I came down, after we have to pick our profit before interest and tax, then we now ask ourselves, do we need to deduct interest? What are we trying to get? Are we trying to get the free cash flows to everybody, or we are trying to get the free cash flows to only the equity holders alone? If we are trying to get the free cash flow to only the equity holders alone, that means that we have to settle them away, settle them. But if you are trying to get the free cash flow to everybody, we don't need to settle the debt people. We just go on to calculate our free cash flow. Okay, so that being said, let's continue. So when I come over here, we now say, okay, we settled our tax first, meaning we are not settling the debt holders. We settled our tax first. After that, we now less the non-cash items, okay, which is capital allowance. We less it. The next thing is that we now consider, do we have asset we want to replace, asset we want to buy? Do we also have working capital that we need to check whether it's increasing or is this decreasing? In the question, we only have capital expenditure. So that capital expenditure is what we considered. We did not have working capital to consider. So at the end of the day, we now have our free cash flows to the total company. So this is what we have. Then they gave us, Now, you know that this free cash flow now, we have it in year 1. We're not having it in year 0. As mean we have free cash flow in year 0, there's no issue. But all the free cash flow, they are in year 1, they are in year 2, they are in year 3, they are in year 4. So what do we need to do? We need to discount them back to year 0. We want to take them back to year 0. So because we now check it, this is our cash flow that we have. This is our cash flow now. Okay, our cash flow here, they are not identical. Look at the cash flow. They are not identical. Okay, they are different cash flows. One is 20, the other one is 28, the other one is 30, the other one is 32. Assuming we have 20 all through, we can easily go and use our annuity formula. But we have different cash flows, So what we do, we are going to use single year discounting method. So what are we going to say? We're going to say, okay, you know this discounting method now, 1 over 1 plus r raised to power n. So let's do it at the side so that we understand how they got what they got in the question. So let's come here at the side here. At this side, I want to do something like this. Okay, I want to do something like this. So I will not say at the bracket, I'll say 1 divided by, right? Okay, I'll now open my bracket again. I'll say 1 plus r. Our r in the question is actually 14%. So our r is 14%. So 14%, 14 divided by 100, we are going to have 0.14. So 0.14. So that's how we got our discount factor. So when we say 1 over 1 plus r raised to power the number, we are raising it to our raised to power n. Our n here, we are talking about year 1. Our n is 1. Okay, let me come here. Let me just click this thing like this. Hold on. Yeah, so we just click this line. So we now have our n here, right? Our n is year 1 because we are dealing with year 1. So when you do this one mathematically, you say 1 plus 0.14. I think you're going to get 1.14. That's what you're going to get. So anything you raise to power 1 is also that number. So 1.14 raised to power 1 is also 1.14. You now say 1 divided by 1.14. What are you going to get? Okay. Are we together?
Yes, sir.
Okay.
For year 1, we have 0.877.
So year 1, we have 8 point, what do you call it?
0.877.
Okay, that's what we have over here. So I just wanted to show us so that we know how to draw all these things that we have over there. So let me try and get an arrow to indicate where that thing is gotten from. So I come to insert and look for arrow. Let me see. This arrow. Okay, so that's
okay.
how the job. Can you hear me? What's the issue?
Nothing,
Madam.
nothing, sir.
Okay. You scared me.
Sir, hello? Sir.
I can hear you.
Sir, hello?
I can hear you. Go on. Go on. Hello? I can hear you.
Yes. I asked a question to ask, but my network is very bad. I could not see the screen, but it's like I'm seeing it now. So what I want to ask is, this capital allowance, why do you first of all deduct it, then later add it back?
Okay, so this is it. Normally, you are trying to get accounting profit. Your profit before interest and tax is an accounting profit. So you have to follow the normal accounting rule when you are calculating your profit before interest and tax, right? As an accountant. So it is that profit that is calculated by the accountant that will now peak. Now, because the reason why we are doing cash flow statement is because we don't want to rely on the accounting profit that we have, because that accounting profit can be misleading. There are a lot of things that is cooked inside that profit that does not involve money at all. For instance, when you have exchange rate gain, okay. Now those things, they don't translate to actual cash. It's just in your head that you are saying there is a gain. I made a gain. The thing was you have already converted it before. Then on the another reporting days, you continue to continue to revalue that money. Okay, so that you didn't actually make money. It's not like cash flow to you. So those things. Then also things like depreciation, it does not involve movement of cash. So they cannot rely on accounting profit. So this is an accounting profit. They can't rely on the accounting profit to make decisions. They usually go and try. You can see that even the tax man, after you've gotten your accounting profit, the tax man will still go and calculate his own taxable profit. So meaning that our accounting profit is not reliable. There are a lot of assumptions that the accountants make that is allowed in accounting, but in real life, it's not actually tenable. So because in accounting, you have to try to calculate an accounting profit, you need to follow the accounting rule. The accounting rule is you normally deduct your depreciation, okay? You normally deduct your depreciation before you get your profit. So you have to follow that rule. So when you are done with your accounting profit, that is why I painted this thing. This is where accounting rules stop. After this accounting rule, here is where we now look at only cash, only things that involve movement of cash. That is what we are dealing with here. So because capital allowance does not involve movement of cash, we have to add it back. So we have our profit that we've made, right? The next thing is to calculate our tax on that profit. Then the next thing is you add back your capital allowance because it's a non-cash item. Then another thing you needed to deduct is in case there's a capital project you want to embark upon, you need to deduct the capital amount. If there's also a working capital that you want to whether increase or decrease, you also need to consider that. So once you are done with all those things, you do your plus and minus, you solve it mathematically, you are going to get what the free cash flow is. And remember that this free cash flow that we have is to the entity. So this is, we have free cash flow. I'm coming, let me do something. Free cash flow to entity. So this is free cash flow to the entity or to the company. So let's say free cash flow to the company. Let me put it that way. So we have got free cash flow to the company. Okay, so that means that the free cash flow we have belongs to both the equity holders and the debt holders. Now, because of that, because it belongs to both the equity holders and the debt holders, that is why we are discounting it with the weighted average cost of capital, which is 14%. So that's why we are using the weighted average cost of capital that they gave us in the question to discount it to present value. So when we discounted it to present value, with the discounting factor, we haven't got the discounting factor. So one thing you must do, first of all, check your cash flow. Are my cash flow, are they identical? Are they the same? If they are the same, instead of you wasting time tweeting them one after the other, you can just go and use annuity formula for everything. We're going to see annuity formula in this question. We're going to see perpetuity. We're going to see a lot of things in this place. So I needed you to pay attention, concentrate on this, because this is simple. As simple as it is, there are some technicalities in it. Okay, we now continue. We now say, okay, we are gotten our cash flows, right? Now we now ask, this cash flow that we have, does it belong to only equity holders? We said no, it belongs to everybody. So we're going to pick our weighted average cost of capital. We use that to get discounting factor. Then we now multiply the discounting factor to the cash flows so that we can now get the present value of the cash flows for each of the years. Okay, we are not doing, so we got it for each of the years. So if we now add everything together, right? You add everything together. What is our answer if we add everything together? Let's see. That means that we are trying to get our present value from year 1 to 5. Are you with me?
Yes.
Yes.
Okay, so we are trying to get the present value from 1 to year 5. So you add it together, and that is how we are going to get it. So hold on, I'm coming. Let me just do something quickly before I continue the call. All right. Quickly before I continue the call, I just want to do something. Okay. So yeah, so that is it. Okay, so now let's now continue. Now, yeah, that's that. So we understand how we got this this amount now. We're getting our present value from year 1 to year 4 to be this amount by adding all these things together. Okay, we added everything together. Confirm that is correct. Let's quickly confirm that. We say, let me quickly do that. Let's see. We have
It's correct, sir.
it's correct. Fine. So since that is correct, we've gotten it. Now let's now go back to our question. We've gotten our present value, the value of the company. We've got it from point 1 to point 4, from year 1 to year 4. But is this all that is needed? Let's check the question. The question is saying, calculate the value of the company. If you can see, so it means that this is not, if you just go to the exam and you just cram this one in your head and you feel you are done with the question, no, they're just starting the question. So they say you have already gotten your present value from year 1 to year 4, but that is not all. Look at what the question is telling you to do. Say, calculate the value of the company if, number 1, cash flows are expected to remain at year 4 level, okay, into infinity. So cash flow, let's assume cash flow in year 4. In year 4, you can say the cash flow that we've gotten to point year 4, we have gotten it to be like 700. So that 700 now remains the same. So year 4, year 5, 700, year 6, 700, year 7, so infinity. Cash flows remain the same into infinity. So whenever cash flow remains the same into infinity, okay, no ending, then we can say that something is calling us. Okay, so look at it now. Look at it. Question number 1. Question said the cash flows are expected to remain at point S4 into infinity. What does it mean? Note, anytime the cash flow is going into infinity, we call it a perpetuity. Now, there are 2 types of perpetuity. We have a perpetuity with growth, and we have a perpetuity without growth. So we are going to learn the formula as well. So apart from you knowing the normal discounting method, apart from you also knowing the what's it called? Apart from you also knowing annuity formula, annuity method, we also need to learn what perpetuity is. There are 2 types of perpetuity. We have a perpetuity with growth, and we have a perpetuity that is constant. Now, when anything is going into the future, infinity, perpetuity is calling you. You now ask yourself, the perpetuity that is calling us, is it the one with growth or is it the one without growth? Okay, so let's look at this one now. They say, note, anytime the cash flow is going into infinity, we call it perpetuity. The present value of a perpetuity depends on whether the perpetuity is constant or whether the perpetuity is growing. Okay, the present value of a perpetuity determines, so as I said, they say that the present value of a perpetuity depends on whether the perpetuity is constant or whether the perpetuity is growing. If it is constant or growing, they have got different formulas. So if it is constant, there's a formula for it. It's growing, there's a formula for it. We've already agreed that this thing is going into infinity. And then we also agree that anytime something is going into infinity, it's a perpetuity. The next thing we have to ask is that cash flow that is going into infinity, is it constant or is it growing? Okay. Obviously, in this place, they say that cash flows is going to remain, is expected to remain the same. okay, at point S4 into infinity. That means obviously the cash flow is not growing. Okay, the cash flow is not growing. So let's continue. They say that if the perpetuity, so let's now look at it now. We are here now. They say if the perpetuity is constant, right? If the perpetuity is constant, the present value is equal to that constant cash flows. Okay, the constant cash flows that you are talking about, right? So divided by the cost of capital, right? Multiplied by the discount factor of the base year. So let me explain to us. Forget the present value of this perpetuity. Okay, the reason is because we already know that this perpetuity is not growing. This perpetuity is constant. So you will not see growth in the formula. Okay, that's the only thing. You will not see growth in the formula. But for a perpetuity that is growing, you are going to see growth in the formula. Okay, so when a perpetuity is constant, we now take that constant perpetuity, that constant cash flows. Okay, you know, is that cash flow that we're looking at? You go and take that constant cash flow that they're talking about. Okay, you now divide it by the cost of capital that they gave you in the question. You divide it by the cost of capital that they give you in the question. Whatever answer you now get, you now multiply it by the discount factor of the base year. So now, if this perpetuity is constant from year 4 to infinity, if the base year is year 4, we're now going to check what is the discount factor that we use for year 4. Okay, so this is the discount factor that we use for year 4. Okay, then what is the cash flow of year 4? Also, you also check the cash flow that we use for year 4. You also check it. It's going to be useful in our formula. Okay, so you also check it. It's going to be useful in our formula. Okay, let's continue. I've been able to explain that. I told us we have a constant cash flow. So, and the cash flow is constant into infinity. That is a perpetuity that is constant. The formula, pick that cash flow that is constant, divide it by the cost of capital given, then multiply it by the discount factor of the base year. Okay, so that is that. Then when we have a perpetuity that has growth, that is growing, okay, the formula is get the cash flow now into bracket 1 plus the growth rate. So the cash flow now that is growing, you know, we have a cash flow in point X4, or let's say we've already gotten our cash flow discounted from point 1 to point 4. So the cash flow now is now going to grow from point 4 into infinity. That means that from the 5th year to infinity. So here now, this one now is the first one is constant. That's why we did not put growth. But the second one is now going to grow. The cash flow from year 4 is going to grow from year 5 into infinity. So what do? Take that cash flow now. That is the cash flow of year 4. Now put it into brackets 1 plus the growth rate. You close the bracket, right? Once you close the bracket, you divide it by the same cost of capital that you have here. When you divide by the same cost of capital that you have here, then at the top, you are adding the growth rate. At the bottom, you are subtracting the growth rate. So take that cost of capital that we have in year 4, or whatever the base year is, put it into bracket 1 plus G. Then close the bracket and put it over the cost of capital that they give in the question minus the growth rate from it. Then multiply it by the same discount factor of the base year. Okay? So if that is noted, then we need to continue. Okay, so quickly, before we go on, there's a class going on. I need to stop the class before the recording starts recording to infinity, just like the perpetuity. Okay, so let me quickly go to that class that we're recording and undo the class. Okay, so yeah, so as I said, we need to understand that. Okay, so we need to understand that, and that it is. Okay, so yeah, so the class has ended actually. The class has
So we can't hear you.
oh, sorry, I didn't even know. Sorry for that. I didn't know that you were not hearing me. Okay, so now let's now continue. Now, in this place, now, I said I was trying to tell you that the difference between a constant perpetuity and a growing perpetuity is only the growth. So what do? Learn the constant perpetuity alone. If you learn the constant perpetuity alone, then to get the growing perpetuity, just add growth rate to the cash flows and less growth rate from the cost of capital, and you have already gotten the growing perpetuity. So it's as easy as that. So to get the perpetuity that is the perpetuity, take the constant perpetuity, add growth rate to the cash flows at the top, less growth rate from the cash flow at the bottom, and every other thing is the same. Any other thing is the same. So that's how we get our perpetuity, both the constant and the growing. So let's move further. Let's now come where you say, question said the cash flows are expected to remain at X4 levels into infinity. So the cash flow is constant. So the question to ask ourselves is that, what is the cash flow that we add in year 4? Let's go to the top. What is the cash flow that we add in year 4? So look at this cash flow now. In year 1, we had 20. In year 2, we have 28. In year 3, we have 30. In year 4, we had 32. So this is the cash flow for year 4. Then what is the discount factor that we use for year 4? We also use this discount factor for year 4. We use 0.592 for the discount factor, and then we got this cash flow for this. So is that cash flow that they are talking about when they were referring to a cash flow is remaining the same from year 4 into infinity? So that is the cash flow they are talking about. So since that cash flow is remaining the same from year 4 to infinity, it means that we have a constant perpetuity. So what do we now do? We now say, okay, this is a constant cash flows as it would stay at year X4 to infinity. The free cash flows at year F4 is actually 32. And that free cash flows will stay constant till infinity. The cost of capital / weighted average cost of capital is actually 14% according to the question. And the discount factor of the base year is that discount factor that we use to discount this cash flow in the first place. The discount factor is this 0.592. So that is what we use. So we now come over here and then we now come and solve for it. So since we have already gotten present value from year 1 to year 4 to be this amount, right? It means that one can now get from year 5 to infinity. So how do we do that? We now say equal to the cash flows, the cash flow of the base year, right? Multiplied by the discount factor of the base year, divided by the weighted average cost of capital given to us in question. We now come here. What is the cash flow of the base year? The cash flow of the base year is 32. And why is 4 the base year? Because here we are calculating from year 5 to infinity. The base year is the year that we have solved for before the year that we have not solved for. So we now have cash flow of the base year divided by weighted average cost of capital that we use in the question, multiplied by the discount factor of the base year. At the end of the day, you solve this mathematically, and then you are going to get your answer. So here, if you apply the rule of BODMAS, whether you multiply first or you divide first, so you're going to get the same answer. Okay, whether you multiply first or you divide first, you're going to get the same answer. So let's put down BODMAS. So what is BODMAS saying? BODMAS is saying brackets, then any other thing that is not bracket, that is not division, that is not multiplication, addition, and subtraction, you deal with it. So brackets, then after O, you have division, you have multiplication, you have addition, you have subtraction. So you see, this division and addition, anyone you do first, you get your answer. You see this addition and subtraction, anyone you do first, you still get your answer. So these two, they are on the same level. Addition and multiplication, they are on the same level. Division and multiplication are on the same level. Addition and subtraction are on the same level as well. So whichever you do first, you still get your answer. So we come here to BODMAS. So do we divide first or do we multiply first? Anyone you do, you get your answer. You can try it. So let's say 32 divided by 0.14, whatever you get, multiply by 0.592, you are going to get your answer. So that is how to treat perpetuity. So we have done our perpetuity now from year 5 to infinity, and this perpetuity is a constant perpetuity. So we now say, okay, to now get the total value of that business, because we got the value of that business from year 5 to infinity. What about the value of the business from year 1 to year 4? We have already calculated for that before. So to now get the total value of that company from year 1 to 4 and from year 5 to infinity, we have to add together. Okay, we add it together, and then we are going to get our corporate value. This is our corporate value. Okay, that's our corporate value. Now they now went further. Let's say if I need the value of equity, we've gotten our corporate value now. Okay, now to get free cash flows is different from to getting value of the company. Free cash flow is you can just get free cash flows to equity, free cash flows to the company. But if you want to get free cash, the corporate value or the debt value or the equity value, you have to multiply. After you've discounted your free cash flow to present value, you now multiply it by the weighted average cost of capital. If you are trying to get the value of the company in total. But if you are trying to get the value of only the equity, get the free cash flow to equity alone, yes, then you is it multiply? Yeah, discount it by the cost of equity. I mean to say, so you're not discounted by the cost of equity. So let's move further. And I say that, okay, if I need the value of equity, I will check the question to see if there is debt value. Okay, I need the value of equity, right? I need to check the question if they've given me the debt value already, they have to give me one. They must give me one for me to get the other. So I will check the question whether they have given me the debt value already, and I will need to less that debt value for my corporate value in order for me to get the equity value. So in the question, if you go back to the question, this question told us that, where's that place? The question told us that, where is that place exactly? I can't even see it. Okay, so this solution. So the question told us that the corporate value, where's that place? The debt value, I need to say, assuming the company has a weighted average cost of capital of this amount, and then the market value of debt, look at it. So this is what I was referring to. The question has given us a debt value already. So we come here and we need to paint it. It has given us a debt value already. So it must give us one. So it has given us this one. So if the answer is 30 million, we now come back to this place and say, where is that place? All right. So now let me ask us a question. Do we understand it to this point? Do we understand it to this point, everybody? Do you understand it to this point, everybody? Or mute and let me know. Do you understand to this point? Hello?
Yes, I understand, but for better understanding, maybe we should solve it because
Okay. So no problem. So let's go and check. Yeah, let's go and see. So let's get our Excel template. Our time is fast spent. We have about 3 minutes more. So let's see if we can quickly do justice to that. So let's solve it together and let's see what is going to happen. So let me come and check for the file that we're using. Okay. So let me check for book.
Mr. Johnson, please, I want to suggest something.
Go on.
Okay, please, I wouldn't know, it's just a suggestion. Considering time management and also for stress free for you, not to consume too much of time, not to stress yourself. Is it not better that once we have a question, we just go straight to the calculation, then you explain why we are calculating? I think that will be more faster time.
Okay.
It will manage our time and it will not even stress you too much. Just a suggestion.
Yeah, that is noted. So I'll work on that based on your advice. I'll work on it based on your advice. So let's now move further to see what we needed to do. So let's come down. We are looking at the value of the company, right? So we're looking at the value of the company. Value of the company. So the value of the company is always gotten as the free cash flows to the company, to the entity. Okay, so you have free cash flow to the entity multiplied by the weighted average cost of capital. So free cash flow to the entity multiplied by the weighted average cost of capital. So this question is saying that, let's go and check that question. Let me take this my screen to the side, and I go and pick the other stuff. But this one. Okay, so this is what we have. Let's quickly go to the top. Yeah, so at the top here, we have this question, right? So let's start. Should we start from the very beginning, like from all this questions? We start from here. The way we were able to
please.
For our free cash flow, Abby?
Yes, please.
Okay, so this is what we're going to do. Yeah, so normally you need to get your accounting profit. That's the first thing to do. So calculating the free cash flow, calculating the free cash flow to the entity. Okay, so we now come over here, we now say, let's get our accounting profit first. And remember the format that we are giving. So let's also get the format down here. So let's get the format of how to calculate our free cash flow. So formats. The format that we are supposed to use. First, what we are going to do is that we take our profit before interest and tax. We take it and it's this place XXS. Then we now what we do, we now decide, are we to less? So if we are getting if we are trying to get free cash flows to the total company, then we only less tax. We less tax at the tax rate, okay? At the rate applicable, okay? So we less the tax, okay, which is going to be times the profit before interest and tax. So whatever you get, you come and put this in brackets. Okay, so you do that. After you've done this, then the next thing you want to do is that you now check for depreciation. Add back depreciation or non-cash item, depreciation. So you add back depreciation. So you are going to have a positive figure. Yeah, so that's our depreciation. Then the next one, after you've added your depreciation, you now ask yourself, there are two things you need to consider here. Ask yourself, do we have a capital expenses that we want to want to incur, capital expenditure that we want to incur? So you need to jacket it also. You need to deduct it so that you not spend that money recklessly. You need to have that money set aside. Number two, you also need to now less, okay, or add. You need to less or add, increase or decrease in working capital. So you need to do that also. So you are going to come over here. Now, if it's an increase, you are going to, if it's an increase, you are going to less. If it's a decrease, you add. Okay, so that's how it's going to be. So let me come over here and do something. So let me shift this one. Okay. Okay, so that is how it will be. Then the next thing we want to do is, once we are trying to create the format, so after we've done all this, then the next thing we are going to do, when we now do our plus and minus, we're going to give us our free cash flow. We are going to get our free cash flow to the entity. However, if it's not free cash flow, so in bracket here now, so this is going to be format of free cash flow to the entity. So we close it. So this is the format of free cash flow. But if we want to get the other one, if they told us that pay off the debt holders, so this is what the answer is going to be. The answer is going to be here. The answer is going to be here. So if they tell you that, okay, pay out the debt holders, what are you going to do? This same format is what you're going to pick, but the only adjustment you need to do, I will show us. So this same format is what you're going to pick, but the only adjustment you're going to do, I'm going to show you. So if they tell you that get the free cash flows to only the equity holders alone, then there are three things you need to do. So let me just delete equity holders alone. So there are three things you need to do. The first thing is that where you have your tax, before you deduct your tax, first of all, deduct. Why am I not seeing? Hold on, what's going on? I want to add something here, but it's not working. Okay, inside. Okay, yeah. So now in this scenario, there are three things you need to do. The first thing is that before you call less your interest first, before you less your tax, less interest, because we want to settle the debt people away. So less interest, So you less interest, you come over here, put it in jacket, and then you less it like this. Okay. Now, the next thing you want to do is that apart from you lessing interest, you still want to do two things. When you have determined whether you are lessing your capital allowance, whether you are lessing your you less your capital expenditure, you less or add your working capital, increase or decrease. Then before you now have your final answer, which is going to be your free cash flow, before you have that final answer, you are going to do two things. So you now come over here. You are going to ask yourself, these people that I am owing, when I issue that the debt instrument, how much was I able to raise? So you add the cash that you were able to raise, cash raised. So the cash that you raised, okay, from the debt that you issued, from the debt issued. So the cash that you raised from the debt issued, we need to add it. Okay, you now come over here, you need to add it. It's going to be a positive, right? Then another thing to do, you now less the debt that you've paid, that you've repaid. Okay, the debt repayment, you less it. Okay, so the debt, so you raise this money, then this is the debt that you repayment, you put it in jacket, and they're going to provide all those things for you in the question. So with this being said, with this format being said, let's now try and use it for this our solution. Okay, so it means that this place I might need to carry. I'm coming. Let me do something. Let me take this thing away from here. Okay, let me pick this thing and move it away from here. Oh, wonderful! Is Excel not sweet? Is Excel not sweet? So this one also, I can decide to take it to the top. I can just copy everything like this, or let me copy like this. Let me move everything to the top. Okay, so I look at where I want to go to. I will take it to the side. So let me just copy. I'm not copying, I'm just moving. Moving it to the top. All right, so we put it, yeah. Okay, so now we have the format that we need. Okay, we have the format that we need. Okay, so Control B, we'll make this one bold. Then we also have the format if we are trying to get only to the equity holder. Fine. Then let's now solve this question. Okay, we're trying to get the value of the company, the total company. So we need to be able to calculate our accounting profit. So our accounting profit, we now go on to say that what is our sales? We have 4 years that we're looking at. So let's have the year. We have year 1, X1. We have year X2. We have year X3. Then we have year X4. Then the next thing we want to do is that we want to say, okay, based on our accounting profit, to get our accounting profit, we need to ask ourselves, what is our sales? Our sales in the question, they told us that it is 230 for year 1, 230. Year 2 is, so let me do something. So year 2 and year 4, year 2 is 261, 261. The other year is 281. The last year is, the last year. Let me check. The last year is actually 298. So let me leave it like that. So the last year is actually 298. So I come here. The last year is 298. Fine. So once we have done with that, we click away from there. So the next thing we want to do is now get the next thing, which is our cost of sales. So we have our cost of sales, and cost of sales naturally be debited. So we say open our bracket 115, close the bracket. Oh, open our bracket 115, then close the bracket. We go to the next place. We also do the same for the next 3 places. Okay, so we now say here we have 131. We close the bracket. Then we go to the next place. We have We have 141. We close the bracket. Go to the next place. We have open bracket. 149. Close the brackets. Okay. So though our time is gone, but we're having advanced tax now. What do we suggest? What is our suggestion? Hello. Do we continue from here next time or during the week? I won't have time during the week anyway. I won't have time during the week. Because
we can quickly wrap up this.
It will take us time, but let's see. Because we are having a case study by 7. So let's continue. If that is what you want. Once we finish this one, we switch over to advanced tax. No issue. So let's now see. So we have done the cost of sales, right? Now the next thing we need to do, when we do this one, naturally we are supposed to get our gross profit. So we can say gross profit naturally, but that is not what we're actually looking for. So we can actually have our gross profit so that you understand that it's actually an accounting profit we're working on. So we now say equal to this plus this, because plus this, sorry. Yeah, so you're going to have 15 over there. You copy this and you make it make sense. You copy, put it here. Okay. Yeah. Even I'm not even supposed to start copying any, because this is they already told us that cost of sales is 50%. And I just use a formula and say 50% times what is at the top, I would have gotten my cost of sales. But no problem. I've wasted that time. No problem. I've wasted the time. Okay. So now the next thing we want to do is once we have gotten our gross profit, what is the next thing in line? We have distribution and whatever expense. So we now come here. We now less our distribution expense. So we less it. We come here. We say minus. What's the answer there? Is that 32 minus 32 minus 34 minus 36 minus 38. So that's that. Then the next thing we want to do is we want to now go to the next. What's the next thing apart from those things? We also have we've done selling and distribution. The next thing we're going to check is our capital allowance, which is our depreciation. So our capital allowance, we have it here. So capital allowance is also an expense. So we're also going to minus it. So we now say minus, what is that? Minus 40 here, minus 42, minus another 42 again, minus another 42. All of them are just 42. Okay, fine. Oh, did I put equals to? I thought I was putting minus. Oh, okay. So let me redo that, please. That is supposed to be minus. Okay, so minus 42, minus 42, minus 42. Okay, that's fine. Then the next thing, we are done with that. So we need to get our profit before interest and tax. So we're supposed to get our profit before interest and tax. So that's what we're going to get now. So we now come over here. We now say equal to our gross profit, because we have got to display gross profit, right? Plus negative figure, which is distribution, plus negative figure, which is 40. You click on enter, and then it's giving us 42. So that is what we're going to pick. We're going to pick it, and we're going to come and put it over here. Okay, that's fine. So we've gotten our profit before interest and tax. So what did they ask us to do? We now start our normal computation now. We want to start our normal computation. So let's leave a gap. Let's leave a gap here and come over here. So we now say our profit before interest and tax. So PBIT, profit BIT is equal to year. So we now copy that place and we now put it everywhere. Oh, sorry. So we put it here, fine. Then the next thing we want to do is we want to now say, are we doing free cash flows to everybody, or are we doing free cash flow to only the equity holders? So we are doing free cash flows to everybody. So no need to deduct interest. So we now come here, we now say taxation, less tax. So our tax is going to be to the bracket, is going to be profit before interest and tax multiplied by the tax rate. What is the tax rate in the question? Is it 30%? So the tax rate is actually, yeah, 30%. So times 30%, times 30%. So that's what the tax rate is going to be. So what do? We now say equal to our profit before interest and tax, which is up, equal to this times 30%. Okay. Then we need to now multiply. So let me close the bracket. Let me also close this bracket. I want it to be minus. I want it to show negative. So now multiply it by, so are we times -1 times -1. So it's going to give me negative. So I'll now copy it like this. I copy, bring it here, and I put Ctrl V. Fine. That is fine. So I hope we are following.
Yeah.
So what is the next thing that we need to do? Once we have gotten this that we have gotten now, the next thing we need to do is we need to add back non-cash items. So add back non-cash items. Add back non-cash item, which in this case is our capital allowance. So we're not coming, we're not say equal to, want to add back our non-cash item. So we come over here, we come and select our this team. So when we select this one, we now multiply it by minus times minus. So let's multiply by -1 again. Multiply by -1. Let's get it down to plus. Oh, beautiful. So we are adding back, because in the at the top there, we minus it before. We minus it before. Is negative here before, because it's like an expense here. So I needed to multiply it back by 1 to be able to bring it back to plus. Okay. So that is why we added back our non-cash item, which is depreciation or capital allowance. Then what else are we supposed to do? We now check, do we have a capital expenditure that we need to incur? Do we have working capital that we need to check whether it's an increase or a decrease? Then the last thing, do we have, I think these are the two things, because we are not doing free cash flows to the equity. We're only doing free cash flow to the company. So what we now do is that we now say, okay, let's less our capital expenditure. So our capital expenditure in the question, what do we have as our capital expenditure? We have cash flows needed for asset replacement. We have 50, 52, 55, and 58. So let's put it there. 50, 52, 55, 58. Fine. So we have done that. Then the next thing we want to do is I want to now say, what else? Do we have working capital? Okay, do we have working capital?
The capital expenditure, is it not supposed to be minus?
I didn't get you.
The capital expenditure, is it not supposed to be minus?
Yeah, that's true. So what we're going to do is that we can multiply it by times, okay, so times -1 times -1. Oh, I want to put equals to there. Sorry. Okay. So, or let me just instead of doing all this nonsense, let me just type minus 50. This one is minus 52, minus 55, minus is it 58? 58. Okay, so that's fine. So we click on enter. So once we've done that, then the next thing is yeah. So working capital, we don't have any. Minus 0, minus 0, minus 0, minus 0. There's nothing there. So we now come and do to now get our cash flow statement now. So we now say free cash flow to entity. It's going to now become, what is our answer going to be? Answer is going to be yeah. So we now do equal to our profit before interest and tax plus a negative, okay, to make it have that kind of effect. Now, yeah, plus this one also. Let me see whether everything plus this plus this, then plus last one. Enter. So let's drag down. See this. This. You're supposed to get how much? Yeah, our answer is correct. So that's correct. So we now come over here. We copy this. Then we now make it show in all these places. Yeah. So that is that. So now we've been able to get our cash flow for the whole period. So let's compare our cash flow. Oh, did we get this thing well? It's like there's something wrong with this our computation. Something is wrong with our computation. There's something I didn't do. Capital allowance is 40, 42, another 42, another 42. What is wrong with my computation?
I don't think anything is wrong with it.
Come again, what do you say?
I said I don't think anything is wrong with it. Since we are doing for the entity, not for equity, we would have recognized the debt and other things. But this is for the company, so I think we are right. I wouldn't know.
Yeah, I think supposed to be right. Supposed to be right, but why is it not right? It's not looking right. So let's go and check our solution. I think that our free cash flow, because when we got to year 4, these are free cash flows ought to be like 32. So let's check what we did that is wrong. We can see that our free cash flow is actually supposed to be 32. Is this our computation wrong here? Okay, yeah, already. Yeah, let's check our from here. We have 43 here, we have 55 here, we have 62. How did we get 62 here? And then how did we get 69 here? That means from here is where we are having it wrong. Yeah. So this is 28, that's correct. This is 34, which means here is supposed to be, let me see, here is
The 62 is right.
come again.
I said the 62 is right.
Okay, this 62 is right, Abby. Our 144, uncle.
Yes.
Is it
Then
also
the
right?
145 is wrong. It's supposed to be 69. This 145 for the last year.
Hold on, no. You know, we are picking the same formula is what we use for. We are using formula. This thing here, I'll probably pick it from here, Abby. The same formula is what we apply. So let's check what did we do wrongly. From the beginning, we have 49 here. This is 141. This is this. It's fine. Then from here we have 32 here, 34, 36, 38. It's also correct. Here we have 40, 40. what do you have? 40, 42, 42 again, 42. So if the same formula is what we use for this place, and it's the same formula that we are dragging toward this place, that means this one is what is wrong. Do you understand? So let's try.
Okay,
let's
the
take
38 here does not have minus.
which of the 38 are you
4.
talking about? Year 4.
Year 4 distribution.
Oh, no
Supposed to have
wonder.
minus sign.
Oh, imagine. So one needs to be very careful so that I don't go and miss in exam. It's correct now. So that is why one needs to pay attention to details, because I'm looking at it. If the same formula we use is what we use for everything, then what is that for? What is that wrong? So we are able to get all this like this. Then the next thing we need to do is that we now need to, let's take it back. We need to discount it. We have gotten the free cash flows now. These free cash flows are in the future. This first one is in year 1, year 2, year 3, year 4, year 5. Now, the next thing you need to do is that you need to compare these cash flows. Are they the same? They are not the same. Some 21, this is 27, this is 34, this is 32. They are not the same at all. Assuming they are the same, you could have used a formula to discount it, which is going to be annuity formula, right? We could have used that, but because it's not the same, we will not use annuity. We are going to use equal different years discounting factors. What we're going to use. So what we'll now do here is I will now say here we are trying to discount factor at 14%. I mean 14%, 40%. Yes. So at 14%, we now come over here, we now say equal to, we now say that we open our bracket, we say 1, okay, divided by 1 divided by, we now open another bracket, say 1 plus R. Our R is actually 14%. 1 plus 14%. Oh, sorry. Let me redo that, please. 1 or 14%. Okay, so let me come like this. Let me delete. So 1.14%. We close our bracket. Then we now raise it to power. Raise to power. What is that? Raise to power 1. We close the brackets. We close the brackets. Are we closing the bracket twice? Okay, I think we're closing the bracket twice. So let me click on enter. Let me see. It's giving me an error. So, okay, it's supposed to be 1 bracket. Okay, yeah, 1 bracket. So that's how we're able to get these. Then we now drag it for the rest. But we are going to adjust it because this place, the years are going to change. So this year now is 2. This is 2. And then this is going to be 3. And then this is going to be 4. Yeah. This is going to be 4. And that is fine. So we have gotten that. So the next thing we want to do is that we want to get our present value. So this is our present value. Our present value is going to become equal to this multiplied by, okay, no, multiplied by this. So we'll now take it and then we'll now drag it over to everywhere. We drag it over like this. So now, this is what we now did. We now say present value of x1 to x4 equal to, we now say alt work. Alt did not work. Oh. Sorry. So I'm not supposed to press equal to if I'm doing alt. Okay. So let me click alt equals. Okay, we now come over here, we now drag it like this. Enter. So this is how we're able to get present value of 1 to 4. Then they went further to tell us that this our stuff that it is a perpetuity because number one, they say cash flows are expected to remain at X4 level into infinity. So what is the cash flow they are referring to? So the cash flow is expected to remain at X4 level to infinity. So and then when we have an infinity, when we have something to infinity is a perpetuity. So the actual type of perpetuity, we have the constant perpetuity, we have the growing perpetuity. Now here, since it's remaining constant, that is actually a constant perpetuity. So what do we do to solve? We have gotten our value of the business from year 1 to year 4. So we want to now get year 5 now. So year 5 to infinity is now going to become the formula for a constant perpetuity equal to, we are going to have equal to the cash flow of the base year. The cash flow of the base year. What is the base year? Our base year is 4. So this cash flow, right? The cash flow of the base year divided by the discount factor. Oh, sorry. Divided by the discount factor, which is 14%, right? Then whatever you get, I need to put it in brackets. Whatever you get, you now multiply it by the put in brackets. In bracket. Then whatever you get, you multiply. You now multiply it by the discount factor of the base year, which is this. Multiply like this and click on enter. So that's how we're able to get this. So now we have gotten our year X5 to infinity. We're also getting year X1 to 4 based on what we've done before from our computation. So to now get the value of the company or the corporate value, okay, the corporate value equals to, okay, so I'm not supposed to put equals to there. So the corporate value, how do we get that? We now say equal to this plus this. That's the corporate value, okay? We put on enter. Then to now get the value of equity, value of equity alone, the value of equity, we now say equal to this our corporate value, right? We now minus the debt value that they gave us in the question. In the question, they told us that the debt value is, how much they say it is? Is it 30 million? Let me come here and let me check. Our debt value, did they say it's 30 million? Let me check. Debt value, 30 million. Okay, so come back to this place. Equal to, yeah, minus 30, minus 30. Okay, you click on enter. So at the end of the day, our value of equity is this value, 180. So I think that is where we're going to stop for today. Do we get it? Do we understand? Do we get it? Is it clear to us now? Is it clearer?
Sorry, sister, a question, sir.
Okay, go on.
Please, how do you get this corporate value? Because you added the PV plus. I don't know where you get this 136. This to times 5 to infinity. How do you get times 5 to infinity?
Okay, how did I get times 5 to infinity? Okay. So yeah, so let's come back over here. So this is what we did, right? This is what we did. We had when you have if the year 5 to infinity, you are using perpetuity, there isn't constant. There are two types of perpetuity. It's either the perpetuity is constant or the perpetuity is growing. Okay, the perpetuity is constant. You simply say, so let's look at it now. Before we do this, let's look at type of perpetuity. Okay, let's do here. Okay, so types of perpetuity, right? Types of perpetuity. I hope I'm correct, yeah. So type of perpetuity, we have number one, we have the constant perpetuity. Constant perpetuity. Okay, we have constant perpetuity, which is always gotten by taking the cash flows of the base year. Okay, the total of the base year. Okay, we now divide it. Okay, the total of the base year. Okay, we now divide it by. Oh, let me do something. Cash flow of the base year. F2. Cash flow of the base year. Yeah, so divide the cash flow of the base year by the cost of capital in the question, by the cost of capital. By the cost of capital given to you in the question. Then you now go further to now multiply it by the discount factor. Discount factor of the base year. Multiplied by the discount factor of the base year. So that's how we're able to get what we got. So what do we need to take note of? Okay, let me shift this one from here. I want to shift it from here. I want to shift it backward. Yep. Okay. So the cash flow of the base year divided by the cost of capital given to you in the question, multiplied by the discount factor of the base year. So what is the cash flow of the base year? What is the base year? The base year, or the last year before we go to year 5, is year 4. So what is the cash flow of year 4? The cash flow of year 4 is 32.3, right? Then what is the cost of capital in the question? The cost of capital in the question is 14%. Then what is the discount factor of the base year? The base year is always year 4. Then what is the discount factor of base year? The discount factor of base year is 0.59, whatever. So we just, this thing that we have here is what we now imputed into this formula. Where is that place? This is what we put here. Just say the cash flow of the base year divided by 14%. We close the bracket. We now multiply it by the discount factor of the base year. That's what we did. It's as easy as that. That's how we're able to get this our value. Do you understand it now, madam? Madam, do you understand?
Yes, sir.
Okay, so you understand it. So on that note, I think we can call it a night. Let's call it a day here. I'm not sure we were able to take our.
I want to get how you got the corporate value calculation.
I should tell you how I got the corporate value calculation.
Yeah, just put your cost out there.
Okay, so the corporate value calculation is gotten by saying the value of year 1 to 4, okay, plus the value of year 5 to infinity. You know, we just look at how we get our year 5 to infinity, plus the value that we got before, because we needed to get the value of the company. There are cash flows that the company already have from year 1 to year 4. So we are also now calculating from year 5 to infinity. So we need to now have everything together to have the value of the company. So we now take the present value of the company from year 1 to 4. We now add the present value from year 5 to infinity to E, and that is how we're able to get the corporate value. Is that taking everybody?
Yeah.
Are we together? So on that note,
Yeah.
we will call it a day. Then we'll wait for, we won't be able to take our advanced tax today because time is not on our side. So you need to rest a little before your case study comes up. Thank you, everybody, and to have a lovely rest.
Thank you so much.
Okay, so thank you, everybody. See you in the next class. Your class coming up is case study. Okay, see you in the next class.